And welcome. This is Mary Ellen McGonagle with your weekly Edge show for Friday, May 26th. Today, as usual, we're going to take a look at where we close the week for the markets and beyond. By that, I mean we'll take a look at some of those underlying sectors, sub-industry groupings, take a look at really what took place last week, all with an eye toward helping prepare you as we move forward. We're also going to take a dive into some of those headline news that drove price action last week. And then last up, viewer question of the week. And that question is all about how can one play this move into artificial intelligence related stocks. And of course, there's going to be many more than just one way, but I will share certainly areas that you might not normally have in mind. So let's take a look at some of that data from last week. Earlier, we did get news that the S&P 500 has a flash survey that they conduct from businesses, and it did show the economy is growing faster in May. That was earlier in the week. We did also get news on Wednesday from keynotes of the Federal Reserve's latest meeting. And on Wednesday, Powell did cite that the Federal Reserve is still undecided on their rate hike plan. They do have that bank crisis in the background, but also they need more information relating to inflation. And they did get some this week that I will share with you. Of note is the fact that they are on a lookout for a mild recession beginning in the fourth quarter. Of course, we'll see how that materializes as well. We did get the first quarter GDP data revised for that first time, and it was revised higher. We also got news that durable goods orders for April jumped. So at the end of the day, we are seeing a continued certain strength that is remaining within the economy despite the hike in interest rates. On Friday, we did receive core PCE data. That's personal consumption information that is very relevant, highly regarded by the Federal Reserve as a gauge of inflation. And it did come in high at a 5% level, showing that inflation remains sticky despite the rise in rates. However, the markets did not respond negatively. As we will see, it was all about Nvidia and the push into certain areas of the market throughout Thursday and Friday. We also next week will receive data relative to May employment data that also is very closely watched by the Federal Reserve. They're on the lookout for unemployment to increase. They want employment to drop because in turn consumer spending will be reduced and by way of ultimately lowering inflation. And again, Nvidia did come out with earnings after the close on Wednesday, and it certainly had a move as it relates to technology and other areas of the broader markets. So where did the markets close for the week? Let's take a look. And here we are with the daily price chart of the S&P 500. A couple of items to be aware of. First up is the fact that we did see the S&P rally right up to this key area of resistance. That's 4,200. On Monday, we dipped above it, pulled back from there. And then, of course, the latter week rally did push this index back up against resistance again. We closed at 4205, so just a hair above. Now, in order to break above resistance, I will need to see probably close to at least a week of price movement above that 4,200 to convince me that we could, in fact, see more by way of a continuation rally. As it relates to momentum, the RSI is up here in positive territory and trending higher. And then likewise with the stochastics, I do have negative here. I put this together earlier today, but we did manage to close today above that 50 with stochastics now in positive territory as well. So we do have positive momentum. We are above these shorter term moving averages, which is constructive. This 4,200 is going to be a key level for the S&P. Moving on, taking a look at the technology-heavy Nasdaq, another outperforming week, up 2.4% relative to the S&P, which was mostly flat for the week, and we can see this nice rally that took shape again on Thursday and Friday. And looking at possible upside resistance, we're using this August 2022 peak as that next area of resistance, and we really are inching quite close to that 13,200 level. Your outside momentum, RSI and stochastics, both in positive territory as the Nasdaq continues to be the leadership group for 2023. Now, let's go ahead and take a look at some of these 11 underlying sectors within the S&P 500 and take a look. Technology remaining up at the forefront, up 4.3% for the week. Now, the heaviest weighted names in the technology sector are Microsoft and Apple, and they netted out to about a 2% gain. There were other areas that helped propel technology up almost double that, and we will get into that as we move forward. Technology now in an overbought position with that RSI, however, that MACD in a nice upward trend, and we got some nice high volume characteristics on this rally that is reminiscent of other periods where we had a sustained uptrend taking place. From here, let's take a look at communication services, XLC. This was up about 1% for the week. Really, there were only 3 sectors that posted positive returns for the week, and tech and services, communication services are 2 of them. I'll share with you the third moving right along. But we do want to take a look at this area because it pulled back very orderly to this 10-day moving average and a nice uptrend. A lot of this week's movement due to Meta platforms up about 5.5%. Google also a heavyweight 1.7% return for the week. But again, there were other areas in communication services that also rallied, AI-related stocks. So other area positive for the week was consumer discretionary, XLY. Nice healthy 2.4% rally this week, and today on Friday, having everything to do with Tesla and Amazon, both posting sharp rallies on Friday. Otherwise, very mixed in that consumer discretionary area, particularly as stocks come in. Many larger retailers are not experiencing strong numbers, or they are not showing growth prospects going forward. So overall, we did see that pullback with a nice mega cap driven rally on Friday that keeps discretionary stocks in an uptrend. As we move forward, we can take a look. I want you to be aware of some of these areas that are showing relative weakness and take a look. Healthcare, staples, and utilities all underperforming. And these 3 areas had been up in the forefront of this sector review for several, at least 2 months in time. But let's take a look at the deterioration that is shaped up here. This is the staples area that had a nice run from March into the beginning of May before it did fall out of favor. This is all about a shift in consumer spending habits where they are not as readily putting money for these higher priced brand. For many months now, there was strong earnings coming out from these staples names as consumers were showing brand loyalty. But now that inflation is really starting to hit individuals' pocketbooks, they are pulling back and not being as readily open with their spending. So XLP break below that 50-day high volume negative momentum now in place there. Also, healthcare, another negative area, -3% for the week. And I would say that biotech names were down over 2.5%. That's one area, but also these big cap pharmas are falling out of favor. And we can see the negative momentum shift here on this RSI, the MACD, also now in negative territory as some of the growthier areas also in healthcare are suffering as well. Utilities, not an area I follow often. When they do get going, they can be a great way to take advantage of outperformance, but utilities at this point in time flat and then into a downtrend. So those defensive areas not being as attractive, not what we want to see, because when you are looking at that S&P 500, a lot of this buoying here that's taking place is due to those mega cap names. We're all aware of that, but I do want to share with you an equal weighted view of the S&P 500 where those heavyweights don't have that impact. And you can see the downtrend that's generally shaping up among that equal weighted S&P 500. So from here, let's take a look at some highly relevant ETFs that I use by way of staying on top of sector rotation and what's really taking place beneath the surface. First up here, semiconductor stocks. They were up almost 10% for the week, and this is going to be all about Nvidia's earnings. The group had been holding in quite well prior to Wednesday afternoon's release. In that release, Nvidia not only came in above estimates, they raised their guidance for next quarter's revenues 62% above analyst estimates, quite jaw-dropping. In turn, we did see many select semiconductor stocks participate in this nice late week advance. And from here, we can take a look at other areas that also enjoyed a healthy rally into the end of the week. And this is IGV, the software ETF for tech software stocks, up 3.5% for the week. Many of the movers here are going to be AI related, but also we're beginning to see inkling of earnings that are coming in ahead of estimates. As you may know, software stocks, any hint of a slowdown in the economy, they will be hit very hard, and hence earnings estimates have been revised downward. There are companies that are coming in very nicely above estimates, and you can see this nice uptrend in software stocks. From here, we want to be aware, of course, as well of those underperforming areas. And I mentioned to you a shift in consumer spending. This is XRT, the S&P retail ETF. And you can see that general deterioration that's taking place, again, mostly centered around these weak earnings that are being released. More importantly, a weak outlook going forward, mostly due to high inflation and a shift in spending habits. I did want to point out KRE. This is the regional banking ETF. It did have an early week pop due to relatively good news from a larger West Coast bank, but it did fizzle a bit from that. This group does have work to do in order to reverse its downtrend. I do get asked a lot, is it time to buy bank stocks? Not yet. I will need to see a move above this 50-day simple moving average for more than just part of one day. A multi-day, even a multi-week move would be more encouraging, so we can pull this 50-day moving average up into an uptrend and act as support. So while bank stocks did rally this week, they are not ready to be bought, I would say, based on my work. One last area, the US dollar inched up last week about 1.2%, but that uptrend there did push many of the commodity gold stocks were down 1.5% and other basic material names. So let's go ahead and move on. I mentioned to you there is a way to play this move into the AI advance that we are seeing, or AI related momentum. And I will share with you how you can get in front of some of these names. First up, we are going to go into the sector summary view here with the view of technology up here at the forefront. And then from here, I want to share with you a group that is also relatively outperforming the markets that you may not normally be drawn to. Certainly for me, I will look at semiconductors and software, but not so much electrical components and electrical equipment. So I'm just going to pull up this chart very quickly and share with you this downtrend reversal that's shaping up. Nice high volume over the last 2 days in conjunction with that move into other artificial intelligence stocks. From here, I will share with you a couple of names that are in this electrical components and equipment group because they are highly relevant in their work. They help industrial companies, manufacturing firms really improved their efficiency by use of AI. Also, robotics are in there as well, but Jabil, JBL, is at the forefront. We can see the stock is emerging out of this nice base breakout here. Nice high volume characteristics shaping up as the stock advances to a new near-term high. We do have positive momentum, that MACD now in positive territory. This RSI is overbought, but it can remain overbought without being too disturbing. We can also take a look at another stock in that electrical components space, and that is HUBB. When you're looking at these stocks here using stockcharts.com, you can ask for a full quote, and it will provide you with that group that they're a part of, the electrical components. So here we are with Hubbell, HUBB. I will go ahead and mark this chart up so you can see what took place here later this week in response to that renewed interest in AI. And we did experience a nice base breakout, nice high volume characteristics. I'm just going to mark that up. RSI in positive territory. Can't really see that volume, but we can see that MACD already was in positive territory. The company offers a powerful no-code platform for AI, no need for engineers. They, in turn, are marketing certain industries with their service. Last up is FLEX, the company, Flex. This is another manufacturing-focused organization. They came out with earnings mid-month. We can see this nice downtrend reversal, high volume characteristics into a rally, and then a more significant rally later this week. They're all about AI as well as robotic uses in the manufacturing space that helps improve the profit margins by way of improving efficiency among these companies. That's it for this week, guys. I hope you have a fantastic long weekend. If you haven't already, use that link below and you can trial my MEM Edge report. I have a number of stocks on my suggested holdings list that already have and are poised to experience more in the way of upside price action due to last week's development in the broader markets. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.